What's going on, Bigger Pockets? It's Matt Faircloth. So, interesting conversation. For the last 9 years, it's been very easy. People don't realize how easy it was because I invested in 2005 through 2010. Currently, it's been very easy to get a loan. Back then, it was easy to get a loan in 2000, too easy to get a loan in 2005, 6, 7, and 8 with the no-doc stuff and everything like that. But then 8, 9, and 10, it was very hard to get a loan. And so now we're experiencing a world where it's hard to get a loan. How do I get money? I want to buy deals. How do I get money? The first way you get money is to reach into your own network and use books like Raising Private Capital, my book that I wrote with Bigger Pockets, to find money out of your own network. After you read that book and farm your own network for money, you're also going to want to get bank money because bank money is about as cheap as you're going to get. And people might ask the question, Matt, interest rates are today, I can tell you, Fannie Mae, Freddie Mac, and a lot of small community banks are all lending money. I'll put the rates up here in the realm of say 2.5%, right, to 4%. That's today's rates. Today's April 2020, and rates right now are somewhere in that range. Fannie Mae's come down. They used to be they were above 4 right after Corona crazy happened. Now they're sub 4 again, right? Most small community banks are going to be in this range too. And that has to do with the fact that with the source of where banks get their money. They're basing their money based on either the LIBOR, based on the 5, 10, 30-year treasury, on those treasury notes. And all those things are super, super low and on even zero right now. And they're charging something above that called a yield spread. So if they're basing it on LIBOR, let's say LIBOR is at 1, they're going to charge a yield spread, right, of say 2, and that makes their rate 3, okay? So the yield spread is where they make their profit. So people say, money's so cheap right now, Matt. How come I can't get a loan? Let's talk about why it's hard to get money right now and how you can get it, okay? You guys in? All right, I'm in. Let's talk about, first of all, where banks get their money. Most banks, some banks have something called a balance sheet or balance sheet lenders, right? Balance sheet lenders. Balance sheet lenders, and a lot of your small community banks are balance sheet lenders. So what a balance sheet lender means is they're taking the money like off of their balance sheet, out of their cash assets, or getting it somewhere out of their own pocket, one way or another, and they're lending it to you. So it's their money, they're going to loan it to you, and you're going to pay them back on an interest rate and everything like that. They're not going to go and securitize the money. Now I'll talk about what that means next. But a balance sheet lender is not going to securitize the loan, which in essence means they're not going to sell it. So people don't realize this. Loans get sold. If those of you guys who might not own a home or anything like that yet, you might not have seen this, but it's very common for you to go to a closing on your home, on a new purchase or a refi or whatever, and you go and your lender is Bank A at closing, and that's who's writing the loan. You get a letter from Bank B 2 or 3 weeks later saying, hey, we've now purchased your loan. We're not going to be servicing it. So loans get sold. A more complicated way to call it is securitizing those loans. But these banks that are balance sheet lenders do not sell those loans. Most small community banks are doing that. Okay, our balance sheet lenders. That's one way you can get money is by going to a balance sheet lender and asking them straight up. If you want to act like you know what you're talking about, use that term. That, hey, are you guys a balance sheet lender? I was like, oh yeah, we actually are. It's funny you know that term. Speaking their language now, right? The other way they do it is, as I said, they securitize it, and I'll just say they sell it. Okay, they sell the loan. And that's where this kind of stuff comes in more and more commonly because they're trying to develop a yield spread and their profit margin on the loan, and maybe they're selling you the loan at 4% for your interest rate, but they're going to sell it to somebody else behind them at 3.5%, so they can make their half a percent spread and points and origination fees and all that kind of fun stuff. That's well beyond my pay grade and my level of understanding, but I happen to know that in selling mortgages, a lot of stuff happens behind the scenes. I do know a lot about this, but I want to keep this a basic level conversation. Some banks are selling the mortgages. Now, those that are selling the mortgages, well, how are they doing that? Well, they're maybe not lending out their money. They're getting something called a warehouse line, okay? A warehouse line. Now, what a warehouse line is a gargantuan bank or somebody like the Federal Reserve or a large institution is giving these banks big lines of credit saying, okay, well, we're going to give you $500 million. Put your pinky next to your mouth with me. $500 million, $500 million. We're going to give that to you as your line of credit, and you're going to take that and you're going to originate loans with it. Now, you can't just go if they were to just lend out $500 million and in loans, that they would be done, right? They can't just lend out that amount of money and stop. They got to keep the wheels churning, keep their loan officers moving, keep the loans coming out. So what they do is they'll take the warehouse line, originate the loan, write somebody a loan for you borrow $1 million for a small apartment building from them. They write you that loan. Here's your $1 million. Congratulations on your closing. Get on down the road. Then they package that loan with a bunch of other ones. That's them selling it, right? Then they sell all those loans and then they pay back the warehouse line. They're really originating loans. And the large organizations behind them, like Fannie Mae, Freddie Mac, or even bigger banks, or they get rolled up to something called mortgage-backed securities. Again, complicated 202 level stuff, but there's large organizations, including Wall Street level stuff, that buys all this stuff back. By the way, watch The Big Short if you really want to understand how all this happens. Watch a movie called The Big Short. There's commercial mortgage-backed securities, CMBS world, where they collaborate all these commercial mortgages and sell them up on mortgage-backed security stuff. And there's mortgage-backed securities that back our home mortgages for the homes that we all own together, right? So that's folks that sell. Now that I've gotten beyond this, reason number one on why it's gotten hard to get a mortgage is because of Corona crazy and because of the instability of the world. These warehouse lines have dried up. That's a fact. The folks that were writing warehouse lines and giving banks enormous lines of credit to allow them to go out and run around the world and originate loans. And then, hey, I'll borrow $1 million from you, warehouse line folks. Give Matt Faircloth a line of credit for a mortgage for his apartment building, and then quickly sell that to somebody else, right? That warehouse line has pulled back, partly because it's, a lot of that's Wall Street money, and you saw what happened to Wall Street, and partly because of the unpredictability of the world, that we're just not sure where things are going now. These warehouse lines are dried up. So these are now gone, right? If that's gone, that means I have no capital to go and put in to originate loans anymore. So a lot of, on the commercial side, apartment buildings and stuff like that, bridge lenders, folks that are doing big rehab loans and things like that for apartment buildings, those guys are all on the fence right now. Fannie and Freddie are still there. Fannie and Freddie can still lend into mortgages, but we'll talk to that. We'll talk about that in a second. About Fannie and Freddie and how to still make things work here and why these guys are still maybe a little skittish. Securitized lenders are gone for now, right? That's reason number one why it's hard to get a mortgage. Reason number two as to why it's gotten so hard to get a mortgage is this. When banks look at your deal, what they're doing is they're looking at the financial viability of your deal. That's what they're doing when they underwrite your property. They've got an underwriting team that evaluates your asset and they look at the financial viability. Now, if your loan is based on real estate, it's really based on the income that you have. And any loan really is based on making sure that you've got the income to pay your debt service, to maintain a mortgage payment, and that there is a pretty good guarantee that income is going to stay in its place for the foreseeable future, at least for the life of the loan. That's about as basic as it gets. Are there going to be checks coming in from some form or fashion that are going to be big enough that they can maintain the debt service and also pay the expenses for the property and also hopefully pay the owner a little bit of income? There's something called debt service coverage ratio. That's something you guys should look into. DSCR, right? That's really the factor they're doing there, right? And all they're doing is just making sure that you're making enough money that you can cover your debt service and your mortgage and a few bucks for yourself too. Up until what I've been calling Corona crazy, multifamily or even just all residential real estate, which is what a lot of bigger pockets, subscribers and followers are owners of or want to be owners of, single residential real estate, that's what I'm talking about, has been fairly stable, even in 2008. Even with the crash and like that. I'm not talking about property value. I'm talking about from a income perspective. It has been fairly easy to predict what residential housing is going to do from an income perspective, from a rental payment standpoint in this country. That's the multifamily, single family homes, all of it has been fairly stable. Yeah, it's moved a little bit up and down, but for the most part, even during the recession, if you look at what rents were during the 2008 recession, rents stable, property value went like this, but rents fairly stable across the board, right? And that's because it is the first thing that people pay. Their housing expense, as long as people are making income, put an asterisk next to that, as long as people are making income, they're like most people are underwritten to spend about 25 to 30% of their income for housing, right? And if they can't make that income, then they're going to go get it from somewhere else. Or God forbid, you've got a victim and they're going to have to go and live somewhere else or move in with family or whatever it is. But you can easily replace that person with another tenant that is going to be willing to pay 25 to 30% of their income for your housing unit. Now, I am totally compartmentalizing and making people seem like little statistics. That's not the way I look at the world. I look at my tenants as people, little asterisk in there so you guys don't come after me just talking about evicting people and stuff like that. But it is a fact. Up until now, banks have looked at real estate as fairly, residential rental real estate as a fairly stable asset class to invest in, meaning like if the rents are this today, they're probably going to stay about the same, if not go a little bit through the foreseeable future. They don't really have to bake in twists and turns in the market. That has changed. Is there going to be income on your rental property? And I'm talking about like today, just that we live in a big fat question mark right now. That's where we are. There's more questions than there are answers because of Corona crazy right now. Unfortunately, and because of not just because of coronavirus, but because of a lot of things that were happening, lots of debt and corporate debt and national debt and all this other kind of stuff has all kind of come to a head, mostly because of Corona crazy, okay? But we're living in a big fat question mark, and there's a lot of questions on whether or not people in the U.S. are going to have the income that they had before. And, depending on, let's put my beliefs aside and what I think. At the end of the day, banks are not sure whether or not your rental property is going to be able to produce the income that it did over the last couple of years in the future, especially in May, June, July. That's the biggest thing, is why it's so hard to get a loan these days. Like right now, because there's no telling whether or not your May rent's going to look the same as what your February rent did, right? And any landlord will tell you that. Even landlords that have collected most of the rent, they're not going to bet their life savings on May rent coming in on time unless they're 100% Section 8 or something like that, right? Section 8's a whole nother thing. You can leave Section 8 comments in the comment box. We can talk about that if you want. But for the most part, we're going to talk about market rate housing. That's what today. We're not talking about subsidized housing because that really takes income off the table. We're talking about market rate housing for folks that are taking a portion of their income from their jobs and paying it in. We've had such a shift in this country of employment that we were, 3% unemployment rate, and now some will say we're in the 15 to 20% range unemployment range overnight, over a couple of weeks. So the income question, the biggest thing that banks use to underwrite your deal is income. So because this has shifted, that's another reason why it's become hard to get a loan. Now, your balance sheet lenders, your small community banks, are going to use this to evaluate your deal. So if you've got a deal that had good April rents, then you're standing on really solid ground and you want to tout that. So if you guys had really good collections in April, then you want to go to your bank and you should consider a refi now. Why? Those interest rates. You're not going to see rates like that rates like that, maybe you'll see them for the foreseeable future, but banks that are these small community banks that are willing to lend are probably still looking to put some money to work. They may be sitting on their hands. These guys are done. The warehouse line folks and the folks that were selling mortgages and things like that, they're done. Forget it. But your small community banks and balance sheet lenders, they likely will still play ball if you can show that you had income in April. So that's a caveat. If you're not sure if you can guarantee it, if you're buying a property and instead of a refinance, if you're buying a new property and you can't really show good April income. But if you guys, we're looking to refi a lot of our stuff that had really good April income right now. That's what we're doing because we had a pretty good April. So we're going to look to refi some of our properties because I can show we had income, and I can show I think we're going to have a good May too. Can't really show, it's really speculation. But hey, if I had a good May, obviously maybe I'll have a pretty good April too. Or I have a pretty good April, I'll have a good May. Yeah. Fannie Mae and Freddie Mac lend on super small, like on residential real estate that people live in, like single family homes and duplexes and things like that. But they also lend on the whole under end of the spectrum. They lend on big multifamily, like, think 100 units and up. That's what they lend on, things that have a multi-million-dollar purchase price. Fannie and Freddie, because they're government backed, are still in the business. Now, because they're government backed, they're still in the business, but because they're the only ones standing, because these guys went away, Fannie and Freddie, call them F and F, you can still get money from them. You can still get a loan from Fannie and Freddie, but it's become hard to get money from Fannie and Freddie because Fannie and Freddie has changed their terms. Because they're the only ones standing and because they want to make sure about this income, right? Goes back to this. Fannie and Freddie have required an enormous amount of money to get held in escrow. Escrow means money gets held with them for just in case. So escrow could mean what they're requiring is anywhere between 6 to 18 months worth of your monthly payments of on your debt service to be held in a savings account from there or on their side, and they'll give it back to you after you've proven that your property is going to be able to make its monthly payments and not have an income problem. But they want you to pay a lot ahead and just hold on to it. And that's they want you to pay your monthly payments for interest and your principal. They also want you to hold to escrow your taxes and insurance. So that can kill a lot of big apartment building deals or even small apartment building deals, because at the end of the day, instead of you having to put together this much money for your deal, you're now having to put together this much money for your deal to cover all that interest and all that stuff they want you to escrow. Now, like I said, they give it back to you after a period of time. If you can show that your deal is able to perform, you do get that money back, but you got to hold your breath for a little bit to get it back. So Fannie and Freddie are really, because they're the last guy standing in the mid-sized multifamily world, they've changed their terms a lot. Their interest rates have changed a bit. Now they've come back down, but they went way up and now they're back down. But they're still requiring an enormous amount of escrow. This is hard to come up with, this escrow arrangement, especially if you're buying a new property. You got to be able to prove income. Warehouse lines are gone, so bridge loans and lenders that were willing to help you get from one place to another, like a bridge, and then rehab lenders, those guys are done for rental real estate. And there's balance sheet lenders. Now, there's another lender out here we're not going to talk too much about. Those are hard money lenders. Hard money lenders maybe are still going to lend. Those are going to go company by company. And because some of those guys are getting their money from a warehouse line, they're done. They're gone. If they're getting their money on a warehouse line, forget it. If they're raising their money from private investors, like if they read my book, maybe they read my book and then started up a hard money company, like possible. If they're raising it from private investors, they maybe are still in business. Rates may have changed a little bit. Their terms may have changed a little bit. So hard money lenders may still be in business. But again, that's going to go company by company. That's going to have everything to do with where they're getting the money from. Now, things change. Things are changing daily. So let's keep this conversation going. This is not just about the day I release this video. This video is intended to be the state of the market today on why it's hard to get a loan. But I want to hear success stories. Hey, Matt, I just got a loan at 3.9% from his local small community bank. Tell me about it. Tell me what you're getting. Tell everybody else about it. Let's use this video to support each other and have conversations about what we're seeing in the market from lending. This is what's happening today, but let's use this video to monitor what's happening forward. So use the comment bar as an ongoing conversation. Thank you guys. This is a complex conversation, but it is something that we can get through together through resources like biggerpockets.com. You guys are the best. I appreciate you. Have a great and profitable week. Hey guys, if you enjoyed this video, I appreciate you and thank you for watching. Here's a few more you might like, and go ahead and click the subscribe button if you guys want to subscribe to our YouTube channel. And if you guys want a big basket of goodies that we'll send right to you, pick up your handy dandy cell phone and text the word DeRosa, my company, DeRosa, just the word DeRosa to 66866. That is 66866. Thank you.